Hi, my name is Jordan Wilson. I'm on the board of the CFA Society of Saskatchewan, and I'm joined today by Mark Smith-Windsor, who is currently the past president of our board. Mark will share some of his insights in his personal journey to become a CFA and his career. Mark Smith-Windsor is an investment advisor and a portfolio manager with the private client group at IA in Saskatchewan. He advises individuals and corporations on their investments, and he joined the investment community in 2004 and obtained his CFA charter in 2008. Mark has a degree in economics and is also a chartered professional accountant from the CMA side. So I'd like to welcome Mark, and I think my first question would be, we have, I think, 3 people on our board with economics backgrounds: Juliana, Dan Sumner, and yourself. And I'm curious as to, A, why you chose going the economics route in university, and why did that help you segue into a finance and investing career?
Thanks for having me here, Jordan. The reason I did economics is just I fell in love with the subject matter. So I didn't know what I wanted to do coming out of high school and into university. And so I went into arts where you could just kind of take a bit of everything. And the economics prof, I won't say his name, was a boring professor. Like he just was, I'm sure he's an interesting guy, but his teaching was boring. But I loved the subject matter so much that it was my favorite class. And so I thought, well, if it's kind of presented in a boring package and I still love it, then I must be really into it. And it just instantly, the subject matter kind of spoke to me, talking about things like supply and demand. It just made sense to me. So that's why I pursued the economics. I really liked the subject matter. As far as career, like transitioning to CFA, that like in the economics field, there really isn't a lot of job opportunities for people to work as pure economists.
Can we flesh that out? Because that's a conversation I had with Juliana and Dan, is with the economics degree, are there a lot of career opportunities in Canada or Saskatchewan in a pure or stereotypical economics background?
Yeah, not really. So there are some, like there's, lots of different government organizations will have economists, banks will have economists. Dan, who you mentioned, he worked actually as an economist for a while. But there isn't a lot there, and to get into those jobs, you probably want to be having a master's degree or maybe even PhD. There's probably as many economics professors as there are economics jobs. And for me, personally, that wasn't really what I wanted to pursue. It was more, I was studying it because I thought it was interesting. But, I always had an interest in business. And so I did want to kind of go into the field of business. I thought economics was a fine sort of background for pursuing a business career.
And I think that's so true, is that 10 years down the road, economics permeates everything in business or accounting or finance. You have to have, especially an understanding of macroeconomics to succeed in business, to understand, interest rates, unemployment, those sort of things. And that's something I really didn't appreciate when I was in school. And I think part of my problem when I was in college was that economics, I had no practical perspective. Things like elasticities and supply and demand curves. I understood the terminology and how to calculate, but I had no anchor in my own personal life. And then 10 years later, everything sort of falls in place because you see the reality in the world and you go, marginal returns, marginal utilities, all these things now make sense because I've experienced them. So I think that even though economics may not have pure job opportunities for a lot of people, it's such a great segue into other fields.
Yeah, I think it is. The business community kind of tends to recruit out of commerce mainly, but I think the economics field is just as valid. And I think supply and demand, what they teach you kind of in Economics 101 or whichever your first year class is if you can really internalize that, that's a pretty powerful thing to understand that a lot of people don't understand.
So when you came out with your economics degree from University of Saskatchewan in Saskatoon, did you work for any period in a economics related field, or did you immediately go into finance?
Finance right away. Actually, I started before I finished up my degree, actually. I was about 2/3 of the way through my degree, and I was given the opportunity to start at an independent brokerage firm here in town. And they said, if you can get your securities course, you're welcome to start. And so I discussed, finishing up my degree on a part-time basis. And so that's what I did. I started in 2004 and then just, picked up a few classes here and there to finish off the degree.
And when you say your securities course, was that the Canadian Securities Institute course itself?
Yes. So if you're working on the investment dealer side of things, you need there's a Canadian Securities course and a follow-up course, which is Conduct and Practices course, and those are regulatory requirements to work in the industry. It's basically been the same course for many years, and they just update it as things change.
Now, if I'm a finance major in commerce, and I'm a little bit older, perhaps, and I did the Canadian Securities course way back when, but my memory is that if I was a finance major, or even an accounting major with some finance courses, the CSC, the Canadian Securities course, was quite simplistic to get because a lot of the knowledge in that course was taught to me in third and fourth year finance. Not having, unless maybe you did have some finance courses as an economics electives, how hard was it to immerse yourself and pass these courses with an economics background?
Well, there is I do remember an economics section actually in the course. I didn't find it all that difficult, but I was really interested in it. So, I went through the textbooks pretty quickly, and so it wasn't too much of a challenge for me. But other people do have challenges with it, and I think what you're saying about having the background and some business, finance, accounting, that sort of thing, certainly gives you a leg up on the program. But for me, it wasn't too challenging.
Okay, and one of the things when Robin and I spoke, and she's at Scotia, which is a larger organization than probably an independent dealer that you started with. But one of the points she made, which was useful, was even if you don't have that finance background, in your organization as you're taking these wealth management essentials and Canadian securities courses and progressing even through the in-house training, there's such a internal resource center with people that are doing the same courses at the same time, or people that just went through these programs. So not having that finance background, if you do have the enthusiasm and the initiative, there are a lot of internal resources in your company that will help you pass and get through these. So She was saying that, yeah, having the finance background will help on the first step, but it's not a deal breaker if you do come from an economics or a math or, a different background. And I think you'd probably agree with that.
Yeah, it's definitely a passable course. It requires some study, but it is passable. So.
Okay. Now, you're working for the independent dealer. You're taking some internal courses or some Canadian Securities courses as well, or Canadian Securities Institute courses as well to improve your skill sets. Then it probably sounds like you started the CFA program within a year or two after beginning work.
Yeah.
What was that like? Again, not coming from a finance background.
Yeah, I looked at the program and saw that all the portfolio managers, people doing kind of institutional business in the financial centers, they all had this designation. And so I thought, well, that's what I'm going to do. And I fancied myself either like a mutual fund manager or a institutional salesperson or something like that, working in capital markets. And so that's why I chose to pursue it. I think it was within about a year of starting in the business, and studied really hard, ran out of time on the exam, failed it, and realized it was a little harder than I anticipated. So I guess to answer your question is it was, I think not having the background in some of the other finance areas maybe hindered me a bit on it at first, and it was a bit of a just an eye opener about how hard I had to actually work to pass the thing. But I think it is it's a complete course. Like, it doesn't really assume prerequisite knowledge. So I think if you're prepared to study, even if you don't come from, say, the traditional finance background, I think it is manageable. And for me, it actually rounded out maybe some of the areas I didn't have. So if I didn't have the finance degree or the business courses, the CFA brought it all together for me.
Now, I think the one thing that we've discussed in other modules that I've done is that the breadth of the CFA program is so vast. And especially in levels 1 and 2, there is a ton of financial accounting and a ton of economics. So again, it's not all finance 101. If you come from a different background, you may have a competitive advantage. In my case, coming with a financial accounting CA designation, I was able to gloss over all the financial reporting and the ratio stuff because I just spent, the previous 10 years of my life doing that on a day-to-day basis. And economics ranks highly. I think in the first couple of years it's about 15% because it is so important. And I think that's one thing that you would have found you had an advantage on that side of the business.
Yeah, I always did well in the economics section, even the year I failed. That they do give you a breakdown of approximately how you did by the various sections, and I always was in the kind of over 70% on the economics section. So I did find that I didn't have to apply myself as hard towards that area when I was going through the program.
And I think another point that you made, which is interesting, you kind of implied it more than made it, was that the CFA program is not years 3 and 4 of university. It's a completely different beast as far as the breadth and the depth of the topics in each level of the exam process. And I think that's sort of when I talk to the candidates in Saskatchewan, because I had the candidate preparation committees, is that for the ones that didn't pass their first exam, that was the big thing, was I never realized how much work was required because it was so wide. So if you are going to take the exams or enter the program, find people that are in the program themselves or have just graduated to get an understanding of the actual work that's needed, because you don't want to wake up a week before the exam and find out, holy smoke, I'm not prepared, because you've wasted that time. So that would be the one thing. And I think the other point that you did make explicitly was that time pressure is probably also the number one reason why people fail the level exams. And to me, when I went through the program, it was, I'd rather not know everything, but I need to do practice exam under timed pressures, so that when the day comes, I'm not getting 80% on 75% of the exam and running out of time. I want to make sure I get through every question, and I think those are a couple of good takeaways from what you were just saying.
Yeah, for me, it was, you're right in knowing some other people that are going through the program. I didn't, the first time around, I didn't really know many people. But the second time around, I was made familiar with a few people who were taking it, and learned about the study note programs where there's a few different providers, and they kind of condense the material down, and they're a good supplement to the institute materials. And then practice exams. That's how I passed it, was doing the practice exams. If it wasn't for that, I wouldn't have been able to make it through.
Yeah, I think that's key. Now, you ultimately get your CFA designation. Are you still working at the same investment house?
Yeah.
So how has your career trajectory changed from the time that you entered, before you got your economics degree, and then you've worked up taking some courses, and now you've got the CFA? What was your career progression as you went through that?
So I started out basically working on my own client base, and then I was working as a junior to a senior advisor, and basically answering the phone and helping out with his clients when he was unavailable. And that was at the firm I started with. And after a number of years, he left and pursued another career path. And so I took over a portion of his client base. And then in 2009, we switched firms. It was myself and another fellow in the office went to another independent firm as well, and had my own client base, and just slowly building it up through referrals primarily. And then our firm was acquired in 2013, and so that's how I became part of a larger entity. But it's always been doing the same thing as when I started, just with a lot more experience now.
Okay, I want to come back to that, what you do, a little bit later. But when I introduced you as an investment advisor and a portfolio manager. Aren't those the same thing?
That's a good question. Yeah. So in the investment dealer community, basically investment advising implies that you're giving advice, but it's up to the client to make the ultimate decision on the investments. A portfolio manager, you sit down with the client to understand their needs, come up with some parameters for the account, but you are actually able to make decisions on their accounts. So becoming an investment advisor through the investment dealer channel is kind of one step on the way to having the portfolio manager license. But so they're two different things, and the investment advisor is advice, and portfolio manager is doing actual management for clients. So you'll find some clients, they sort of have the view that they don't really want to handle the day-to-day, and so that's where they would use a portfolio manager. Other clients say, well, I want advice, but I still want to be involved in the decision making, so that's where the investment advisor function comes in.
Okay, so if I'm coming out of university and I'm interested in working with IA, I can go two different paths, or I can do a progression with investment advisor and then later on becoming a portfolio manager and combining them. So if I want to become a investment advisor with your company, and I've got maybe an economics background, maybe a finance background, what are sort of the steps that I would go if I applied? Or what if I look online and I see a job advertisement for a 1 to 2 year postgraduate to come join IA and work with you? What would that job requirement say you want for skill sets and expectations going forward for an investment advisor?
Yeah, so I think what I had mentioned about the securities course, so that is one thing that, people do get hired without it, but having it kind of puts you a little step above, because the employer doesn't have to wait for you to go through that course and take the risk that maybe you have some trouble getting through it, and so you can be licensed sooner. So I would say the securities course is probably the number one thing for that role with any employer in the investment dealer industry. And then there's different ways you can kind of start out. I mean, the bank channels have pretty good training programs, and so they will start people out kind of right at the ground floor, and you can kind of work your way up. Another way, a lot of the industry is moving towards kind of a team approach. So whereas 20, 30 years ago, pretty much all of the investment advisors worked independently, now you're seeing more and more of them approach clients on a team basis for a number of reasons. And so you can look at these teams and maybe join onto these teams as a junior person on them. And other than that background, if you have a business background, that's great. But I would say it's not required. Like, people can come from other backgrounds and get into the industry and be successful at it.
Okay, a couple of follow-ups, if I don't mind, is what's this team approach? Why is that becoming more prevalent than the one-on-one relationships?
I think a few reasons. One is there's so much to the business that it's hard to be an expert at everything. So by having people who have their different strengths, different areas that they understand a little better, you can maybe give a more fulsome service to the client. So say if I'm better at the investment side, portfolio management, somebody else is better at the financial planning end of it. By combining, you have a more complete package to offer clients. So I would say that's probably the biggest sort of sales pitch to the client as why, and benefit to the client as why a team approach. The other thing, things happen to people, so clients want to know that they're well taken care of. If so you fall ill, for example.
Yeah, no, I mean that's the hit by the bus. That's one of my philosophies. I think the team approach is becoming prevalent for, as you said, but we're also seeing that clients are becoming more demanding and they want more holistic services. They want comprehensive services. It's not just, I want to deal with my stockbroker and get a buy side recommendation. Oh, it's tax season. I need some RRSP advice. I need some insurance advice. So you're seeing that. You're also seeing, and I put on my UBS management hat, where we don't like client advisors because they control the relationship with the client. I want the relationship to be with the client and UBS, or the client and IA. I don't want it to be with Jordan or with Mark, because when Jordan goes across the street to Credit Suisse and he's a good advisor, he takes those clients with him, and that net new money goes to Credit Suisse and it's a loss from UBS. So to create these teams and to create the allegiance to the bank or the financial institution itself is what a lot of these companies want. They want that tie to the organization. And also the, as I said earlier, the hit by the bus approach, where if you come in and suddenly you get injured or ill or something and leave, it's a smooth transition to other staff members. The other thing, I don't know if you see it in your particular business, is that one of the things Robin and I discussed with women in finance is more and more women control the finances in families and for themselves. And there's at times a desire for women to deal with women advisors. There's maybe a comfort level. So again, building a team, you get away from perhaps worrying about, oh, I'm one specific person, where, okay, I've got a female on my team, I've got this on my team, and I've got different skill sets, and that can attract more people overall than just have a one rainmaker type approach. Does that seem to make some sense?
Yeah, I think all those points are valid.
Now, this is an interesting question. You've got your CFA designation. And then suddenly at some point, the economics CFA guy wakes up one morning and says, hey, management accounting designation, let's add that to my curriculum vitae. Now, you told me earlier you never practiced as a management accountant or any sort of accountant. What led you to get your CMA? And does it help you at all in your current business?
Yeah, I thought, I've always thought with my career, I'm an investment, and so making investments into myself is important, and so that was along those lines. The CMA, I thought, if I ever wanted to be, say, a CFO of a company or something like that, having some better accounting background, I didn't take the accounting courses in commerce, so I wasn't, really up to speed on how accounting works and what goes into financial statements. And I also thought from just a financial analysis point of view, like when I'm looking at investment opportunities, having a better understanding of what goes into their accounting would help me with my existing role. So as far as whether it's helping me right now with my I think it's like does the degree help? Does the CFA help? Does this help? It's hard to pinpoint where exactly it helps, but I think it does. Certainly when I'm looking at financial statements and understanding how they report, I think I have a better sense of it because of going through that path.
That's interesting, because usually I actually tackle it in the completely opposite direction. My first profession was a financial accountant, a chartered accountant. And I went into that for a variety of reasons, but one of them was ultimately I wanted to be on the finance and investing side of the world. And a large part of that is, at the time, analyzing and understanding financial statements and financial data. And so for me, it was, okay, get my financial accounting as a prelude to moving into the CFA side. And I think that's sort of, to me, an untapped area for primarily financial accountants, but also, as you said, with the managerial side, is that if you have the accounting background and you're a CPA and you want to work as a controller or in the C-suite, chief financial officer, chief executive officer, chief operating officer, it's very useful to complement your professional accounting designation with the CFA, because as you do move up, it's less about calculating inventory, first in, first out inventory calculations. It's more about, do we do a debt offering? Do we go public and issue an initial public offering? These sort of things, and that's the bread and butter of the CFA designation, is understanding that. So to combine that with a controller's background as an accountant or a VP finance's background as an accountant gives you some great synergies. So it's interesting that you went the completely opposite. And I do think that, I mean, you're probably tied into what you're doing for the rest of your career now, but it does set you up if you ever did want to go work for a independent, smaller operating company, to have both of those backgrounds.
Yeah, I think like how you pursued it is the more common way. Like I know a number of people with both the accounting designation and the CFA designation, and I think it's a great combination.
Okay. So we kind of talked about your investment advisor. We talked a bit about the portfolio manager side. I'm not sure how you or how IA runs its business, because on a relative basis, it's probably smaller than BMO and Scotia and RBC. But as a portfolio manager, how much flexibility do you have in actually designing portfolios for your client, as opposed to having to run everything by compliance and in-house legal? And a lot of companies, people call themselves portfolio managers, but they're basically just client advisors who have various discretionary portfolios that are handed down from Toronto or Vancouver, and that's what they mix and match for their clientele. But I think you do a little bit more than that in your own business. Is that somewhat correct?
Yeah, so there is, with any firm, there's, they have kind of rules on how they want things to operate. I would say in the PM platform of our firm, they do put guardrails on you similar to the others. That there's probably a little more flexibility than you would find at a major bank. For the most flexibility, you're probably looking at non-discretionary accounts where it's an advisory based. So that's where, basically you set the objectives and then you get, a pretty wide range of opportunities that you can put clients' investments in. The main thing just being that it's appropriate for them and, matches with their objectives.
Now, just to flesh out both of those, you have your discretionary or your managed accounts, and then you have, the non-discretionary accounts, or the ones the client makes the ultimate decision. Why are there more guardrails or less flexibility in the portfolios that you manage, or IA manages, or RBC manages, as opposed to the ones where the client makes the decisions?
I would say that's essentially a risk management function of the firm. I should say I'm speaking in my capacity as
I'm
a
talking in
CFA
general terms.
as a CFA board member, not as my capacity as an investment advisor. But I would say the reason these firms put those controls on is because when you take on or anybody takes on a client's portfolio and takes on the management function of it, as opposed to just giving advice, there's essentially a higher level of responsibility to the client. So with that higher level of responsibility, for all of these firms that do this comes, an expectation that that you're treating their investments fairly. So that's probably why the restrictions. I'm not sure if I'm.
Yeah, no, that's exactly. It's all risk management, because at the end of the day, if you had carte blanche and you could do whatever you want as the portfolio manager, there's limited amount of the clients if you hurt them, impair their performance and the results. You don't have a lot of deep pockets as an individual. So I want to go after RBC. I want to go after Scotia McLeod if I'm a client that's been wronged. It's kind of that deep pockets. And so the banks or the financial institutions need to make sure that everyone falls in line and operates within the agreed upon parameters, because once that falls apart, then it's not just you that's at stake, it's the entire organization. And so there are a lot of things. And me coming from Switzerland, especially with UBS, I've seen people arrested in Miami that I knew personally because of things they did. And in most cases, the bank itself had no idea what these people were doing. And again, you can't have that as an organization. That's the same with the Swiss banks in general. There's a perception that you're hiding all this money for the Osama bin Ladens and the Saddam Husseins of the world. But it's not worth the money that you can make off those characters. It's not worth it if you got caught just on the reputational risk. So there's monetary risk and there's reputational risk. And I'm assuming when you set up a client account where they make the final call, and again, this is just general with all banks, is that the client signs off basically waivers that he or she is making the decision based on a recommendation. But the call is with them at the end of the day. It's not being thrust upon them by the bank itself. Is that somewhat correct?
Yeah, I would say, I'm just speaking generally.
Yeah.
I'm not. I would say that an investment advisor's responsibility is to ensure their recommendations are, appropriate for the client. So I would say it's not just because it's the client signs off doesn't mean that there's no responsibility from the investment advisor standpoint. But there is more flexibility in those mandates, and clients can direct what they want to do in those mandates as well. So clients want certain investments. That's something they can put into those accounts, which does come up.
Now, you've mentioned a couple of times about I'm paraphrasing, but what's best for the client or what's appropriate for the client. It almost sounds like you're talking about, and I'm not quite sure what the term is. Let's use a phrase that I'll create myself called know your customer, know your client, KYC rules. What are KYC rules, and how, just in general, do investment advisors and portfolio managers in any financial institution take steps to ensure they do know what their customers and clients' objectives and constraints and suitability of investments are?
So there's basically a know your client form where you gather information from the client about their circumstance and discuss what they're looking to do or what their objectives are. and basically just evaluate their financial situation, and that determines what recommendations you make to the client. And so that's sort of the basic premise of the industry, is that you know your client, you get, and so when you meet with them, you get to know them and understand their situation, and so that way when we go to make recommendations, we know they fit with their situation.
And that's something that you don't just do once, you would do on a continuing basis every time there's a
major change
exactly.
or something like that.
So if there's a material change that occurs in the client's life, you would update your KYC and make sure that the suitability of the existing portfolio still is in line with what the new KYC and the investor profile suggests or dictates. So I think that's interesting, and I think that it's funny because not that long ago, it was more like the Wild West out there, where Bitcoin or all these things, GameStop, it's hot, get it in. Whereas now the investment advisor needs to look from a holistic perspective at the entire portfolio and say, does this make sense given what I know about the client, what their current investment approach is? And it's not just, we think this is a hot stock, let's fire it in. It's more of a thematic approach to investing, and not just build piecemeal based on whatever's hot. So one of the areas that we sort of touched a bit on with the team approach, but before we get into that, one of my beliefs is that when I came out of university, whether it be an accountant or finance person, I needed to develop my technical skills. From a finance side, maybe that's calculating modified durations, correlation coefficients, all this stuff that you will never use 10 years out. As you move up the corporate ladder, or you become more experienced in your case, I think it becomes more the soft skills, the hand holding, the discussion, the communication aspects that are more important in maintaining or building a client relationship than just sitting down and saying, yep, interest rates are going up, so we need to shorten the durations on your bond portfolio. You have to have a better bedside manner. And so I'm curious as to what your thoughts are on, as you move up the ladder, the need to develop those soft skills and those interpersonal skills.
Yeah, I think they're very important. And it's something that's not really talked about in school, and neither in the CFA program or any of these programs you take, they don't really emphasize them, and they are really important. I think there's some people that are just naturally gifted at it. They're great with people, and other people have to work at it a bit more, and it comes over time. I would say, for me, that's probably an area that I've needed to work on to get better at dealing with people, and over time I think it improves just as you mature.
Yeah, and I think with the maturity, it's less about the maturity, it's more about the confidence, because you've been there, done that so many times that, as I said before we started this, in my first few sessions moderating these talks, I had no idea what I'm doing, and I probably still have no idea what I'm doing by the sounds of it, but you do develop a little bit more comfort level, and hopefully that comes out with a little bit more smoothness. When you talked about building some of your soft skills, do you have any suggestions? Like, the popular ones would be, say, Dale Carnegie, these type things.
You took the words out of my mouth. I did take the Dale Carnegie course. And I took it fairly late in the game. I took it probably about 5 years ago. And it was helpful. I would say, it's like anything else. If you don't apply it immediately, you kind of lose it. But I took a couple of the Dale Carnegie courses actually, and Warren Buffett, if you follow him, he claims that the Dale Carnegie course is the best course he ever took, and that includes his finance stuff. And he keeps the Dale Carnegie course certificate in his office. So I think it's that is definitely a great one. There's other similar programs like that I would recommend.
What about the Dale Carnegie course? Did it teach you to speak better? Did it just give you more confidence? Did it help how you treat people one-on-one? What sort of, in 30 seconds, why should I take the Dale Carnegie course?
Well, it's a bit hokey, so you got to get over that. But I think it is, the whole program is designed around building confidence. So it's the confidence building is a big part of it, but it also so the speaking, and then also just the interpersonal skill set, and there's something that there's not a big emphasis on in university. It's I took it as a night course, sort of took a few Wednesdays here and there for a few weeks out of my life, and every time I took it, I felt great afterwards. And they really build people up. In the course I was in, there were some really shy people in there, like really shy, and they got them out in front of everybody, speaking to the room, and so I think it was good for everybody, and there's people from all walks of life in the course. There were some corporate types, there was blue collar, all sorts, and it's a good program.
Well, I think regardless of what you do, whether you're a barista at Starbucks, you're working at Mr. Lube, or you're the head of potash nutrient, there's similar skill sets, that interpersonal, the relationship skills that are important. In my own background, which I've talked about before, is as you move up the corporate ladder, so much of your day or week is making presentations or reports to senior management within the bank, or dealing with the regulators, or dealing with government officials, dealing with ultra high net worth clients. You need to have strong communication skills. You need to have strong English skills, or whatever language you're in, but you can't give somebody a report that's filled with typographical errors. And maybe you can get away with that in certain contexts, but as you move up the work world, it's that professionalism and the ability to communicate your ideas to people that's pivotal. And as I've said before on one of the other casts we did, I was in a senior management or senior executive program, and we would go off and they would give us advice. And in one session, they videotaped us running a management meeting. And then you went afterwards and looked at your body language and the terminology you used and all these things. And the nonverbal cues, especially, were just overwhelming with how you actually saw yourself on video was much different than how you perceived yourself during the meeting. So that's at a higher level at UBS. Where we focused on was that communication skills. And I also think that you talk about shy people when you talked about Dale Carnegie. I think for a lot of people, you've got to step back, and I always use the grumpy uncle, which tends to be me, someone that can sort of take a look at you and say, Mark, you're a great guy, but this is what's holding you back. You don't sugarcoat it, just say, here's your problems. And if you are shy, that's the person that does need to take these Dale Carnegie courses, Toastmasters, joining a service organization so they get out and they're forced out of their comfort zone. So I think that's key to look at where you are weak. And in my case, I'm a relative introvert type person. And if I'm traveling around the world as the head of a organization, part of my job is to take staff out for dinner and to have these conversations. That's not one of my strong suits, but that's part of the job description, and you need to learn how to do that, or you're going to not succeed. So again, look at what you need to get to the top, talk to people, and then take yourself out of your comfort zone, because that's probably important. So those are kind of the soft skills. One of the other things, not soft skill, but it's complementary skills that I've talked about in other sessions. So if I'm living and working in Saskatchewan, where it's heavy on agriculture, heavy on natural resources, and I'm an accountant, or I'm an economist, or I'm an investment guy, what sort of complementary hard skills might I want to develop? You talked about the accounting, the managerial accounting, which was useful, but should people be taking like geology courses or things to sort of IT courses as we move into that world?
Yeah, I think knowing something about the industries that drive the economy, is a major benefit. Like if technology certainly, that's becoming a bigger share of the economy everywhere. In Saskatchewan, we have a significant natural resource endowment, and whether it's minerals mining, or oil and gas, or agriculture, which is a natural resource of a type, forestry even. Knowing something about those industries, becoming an expert in those industries, knowing your way around about how to have conversations about the various things that go on, is really would set you up. And I think a lot of it tends to be on the job learning, but I think if you can brush up on your skills beforehand, you might as well start ahead of the game a little bit.
Yeah, and to me, I mean, again, I've said this in other episodes of this, where if I'm looking at resumes, and I've got 50 resumes across my desk from finance graduates, and they've all taken the same electives. They've taken the same hard course, they've taken the same electives. Yet I see the one student that has geology or geophysics or petroleum engineering elective. I suddenly say, this person gets it because they understand, what Saskatchewan's all about. And if I was going to Silicon Valley in California, I would want to see the finance skills complemented with high-tech skills. These are the sort of things that you can add value, and also it adds value, but it also shows your potential employer that you think outside the box. Because again, as you move up the ladder, that's what people want, is people to bring solutions to the game, not just problems. And so you say, whoa, this person's thinking a bit. That adds value to my company.
Yeah, for sure. I mean, if you take Cameco, you want to go work for Cameco as an example, and you're an accountant or a finance person, at the end of the day, they're a mining company, and the most important thing they do is mine resource. So understanding something about that, would put you ahead of the game compared to somebody who doesn't.
The other point that you made in passing with learning, say about agriculture, is that people like to work with, like clients and advisors or just business relationships, with their own kind of person. So if I'm out, and I'm not an agriculture guy, but a lot of people that I know in Saskatchewan are farmers or have hobby farms or timber. And by understanding a bit about what they're doing, and even that's just understanding, okay, it's a dry season, it's a wet season, the crop's coming in early, the crops are coming in late. You can have those conversations with them just on a personal level. And then they see you as a similar type of person, which enhances your business relationship. And that's the same. I've got a friend who's heavily into European soccer. And because I understand a fair bit, having lived in Switzerland, about Bayern Munich and Barcelona and Real Madrid, he loves having these conversations because most people in Western Canada can talk the Oilers or the Riders. They can't talk the ins and outs of the English Premier League. Now, you probably...
Neither can I.
So again, it's just they see you as a kindred spirit. And I think that's another advantage.
Oh, for sure. I mean, it's sort of the, if you're going to give advice to someone and you don't know the first thing about what they do or how they make money, whether it's in a corporate environment or a personal environment, you should have some understanding before you can add value, right? So.
Yeah. Now, one of the areas that I've tried to touch on with the other folks is the world is changing, and we see that, or we saw that in our annual webinar, our dinnerless dinner, where with the things like carbon taxes being implemented, maybe natural resources, especially oil and gas, will be the way forward in Saskatchewan for the economy. And we talked about small nuclear reactors, we talked solar, wind, those sort of things. So if I'm sitting here listening to this and I'm in grade 12 or I'm first or second year university, and I want to develop some complementary skill sets on the hard side, 10 years out, where do you see, if I want to live and work in Saskatchewan, the skill sets that I might want to develop? And now there'll always be agriculture, there'll always be natural resources, but where can I develop a niche?
Well, 10 years out, I don't know what's going to happen. I don't think anybody does, but I think certainly the natural resource area is not going away for Saskatchewan. The thing about natural resources is, compared to other industries, is the threat of disruption is low, and when it happens, you see it coming a mile away. So commodities tend to stay around for a long time. Other areas, there seems to be quite a vibrant tech scene. So I would say, being familiar with what's going on in that area is going to help you everywhere. You mentioned the agriculture. I think agriculture is huge. So, and that, we're never going to stop eating as a society. So that's a useful thing as well. I would also say, as far as you brought up the term niche, if you can find a niche, if you find something that makes sense long term and you can be good at, things kind of come in and out of favor, but if you get really good at something, you'll find periods where great opportunities come your way.
Okay. Now, the one thing I want to discuss as we get near the end here is that you're a director of a private natural resource company. And I don't really want to get into the company itself, but I've got a few questions just on that might interest people. So the first question would be, is if I'm an investor looking at smaller mom and pop size junior oil or mining companies, what are sort of the investment considerations that I might make if I'm thinking about investing in a junior mining company? What might be some of the advantages or the risk areas?
Yeah, so I guess the disclaimer, this isn't investment advice. I'm speaking in my capacity as a CFA board member, but I would say any of the smaller resource companies are risky. So that's the first thing I think people think about. The upside. There's huge upside, but the first thing you got to get your head around is the risk. And so on any particular investment, can you afford for it to not work out? And so that goes into how big of investment do you make? And so I would say that's kind of the first thing you look at. Second is what's your feeling about the commodity? Because the commodity will actually probably swing the values more than anything the management does in a lot of cases. So you can run into a scenario where it's the worst operator with the worst management, and the commodity goes your way, and you can actually make more money because the operating leverage they got. So it's the commodity piece is a big one, and I would say it's hard for most people because the time when the best values are there is when they're out of favor, and it's really easy to say you should buy when things are down, and it's hard to do because you don't know how long they're going to be down for or how extended. You take the oil industry as an example. A lot of people looked at it 3 years ago and said, this can't get any worse, can it? It's pretty bad, so we should buy some of this stuff. And then COVID happened and it did get worse and oil went negative. So but if you can buy in commodities that you think have good appreciation potential for the commodity, you've lined that up right. And then the people. So I talked about the example of making money with bad management. Well, you can also make money with good management, and in the juniors, the management does matter. So if you're paired with really good management, sometimes if the commodity doesn't go your way, maybe management can make something happen anyways. And so I would say, does an outside investor looking in learn that? Look at the management's track record. What have they done before? So if they've done it before, that's a good sign. Look at the other investors. Who are you partnering with? It's a capital-intensive industry, so they need capital on an ongoing basis, and especially the junior companies do. So, unless you have the capacity to write the checks to fund the operation, you need somebody else to be doing that for you. So I would say partner in companies where there's a significant major investor that really knows what they're doing in the area.
Yeah, I think that's a great point. When I was running a small junior oil company myself, I remember we were talking one day with a couple of older oil men, and the question that I had was, how do you tell who you should partner with? Because you're always involved in joint ventures and partnerships on drilling wells. And that's what they said was, look to see who these people have partnered with in the past. Because what tends to happen in any sector, regardless of geography, it could be Australia, it could be Western Canada, is that the good people aggregate together on deals and the bad people end up working together. Because if you're a poor performer for a variety of reasons, usually management related, the good people don't want to work with you ever again. So by default, you're stuck working with the other bad characters. So that's a quick and dirty way to find out who you're dealing with. The issue from riskiness with junior companies in general is they lack the capital to diversify their operations. So if you're investing and only drilling 1 or 2 wells in southern Saskatchewan annually, there's a huge amount of risk there because of the non-diversification. Whereas if you're a large company like Chevron or Exxon, you're drilling all over the world in a variety of locations. So again, you're spreading out your business risk and your operational risk in a variety of places. So that's, to me, the risky area with the juniors. But it's an interesting field. I think the other thing, too, that I won't call it inside information, but there's a lot less transparency because you're not having the big research analysts studying the small or the micro or the nano cap stocks. So they tend to fly under the radar significantly, which leads to inefficient markets.
Yeah, I think that's, the inefficiency is there. And in Canada, there is a pretty good cluster around resource financing, but the research coverage certainly isn't there on a lot of the small issuers. So it can be a very inefficient market.
Okay. Now, there's public and private companies, operating companies, in your case, natural resource company. In general, is there a difference between investing in public or private companies?
Well, I mean, the big difference is it's a lot harder to get your money out of a private company if you don't like the way it's going. Private equity as a whole, is becoming a bigger and bigger industry. So there's more and more capital that does devote to private entrepreneurs and private companies because they can do certain things that maybe say they're unpopular for a while, and so they don't fit with the public markets, and so you can maybe take a longer term approach. The downside of being private is there's not the liquidity there for the investors, so you could run into one of the problems with being private is it's hard to sell until the company itself wants to sell, whereas with the public, the decision is much more in your hands about when you make the decision to either buy or sell.
Yeah, and I think that a public company is trading either over the counter or on a public stock exchange, and the value of your shares is what the market will bear. If someone will pay you $10 per share for your stock, that's the value. If they only want to pay $2 and there's no other takers, it's worth $2. Whereas with a private company, it's much different. And it's different even on a level where, because the shares aren't outstanding, how do you value the company? And periodically, depending on how you set up your private equity deal, there may be independent evaluations done on a triannual basis or something. But often the end game is to ultimately go public or be taken over by another company, and that's how you release your shareholder value. Now, I think what you see as well with a lot of private equity companies who are investing in these companies is they create a diversified portfolio, and it's almost like a ladder in the sense that there's always something intended to mature, so that if you have a 10-year holding period for a mining company in Western Canada, then not all the investors have to wait that 10 years. Because with venture capital and these sort of things, it's actually usually about a 10 to 14 year payback period for a lot of these things. So you do have to have a longer time horizon. But there are companies that do try to have a steady deal flow so that they are creating some liquidity for their investors. And the investors are actually investing more in the pools than the company itself. So there are ways that you can invest in private equity and still get a little bit of liquidity and certainty.
Yeah, there is trades that happen, but it's just less liquid. And there's public companies that are about as liquid as private companies too. So
yeah, that's very true. So I think just as we wind up, the question that I tend to ask everyone is, looking back, you've gone through with an economics degree, you became a CFA, you've worked as an investment advisor, portfolio manager. If we look back to grade 12 or 11 Mark, who's just thinking about going into university, or the 24-year-old Mark, or whatever he was, who had graduated from university, what might you tell yourself now as far as training or career paths?
Yeah, I think, I at the time I was reasonably ambitious, so I think I would just tell myself to, pursue your ambitions. So, and especially, when you're young, I would say take some risks, because when you're in your early 20s and you take a chance on something, the downside's not the same as when you're, have a family and a mortgage. And so I would say take some risks and, pursue your ambitions and treat people well.
I think on that risk side, again, 40 years ago, you were almost penalized if you didn't come out of college or high school and get on that steady, career track. It was, well, you're 28 and you suddenly made a U-turn, or you went completely off the rails. You're a failure. But now, I think it's almost the complete opposite, where people do have about a 3-year career span with their companies, and many people are taking on different challenges. So I think at any point in time, you're not going to be punished for that. And in fact, by bringing in other skill sets, that adds value for these companies. So yeah, taking a risk, or taking on different challenges until you find something that you love doing and want to stick with, probably won't hurt you, at least in your formative years.
Yeah, I would, like, for me, going into the brokerage business on an all commission basis out the gates was a risk, but there was no downside to it for me. And so I would say similar things. If you have an entrepreneurial ambition, start it early. Give it a chance.
But that said, is plan it out. I mean, too many people they get a notion in their mind to try something, but the reason they fail isn't because it was a bad idea. It's because they didn't go through the thought process, how to get from A to B. And at times we live in a world of immediate gratification. And whether you're doing your CFA or you're becoming a portfolio manager and just doing in-house courses, it's going to be like a 3 to 5 year progression period. So you have to chart out your course along the way, and not just, oh, I couldn't do this in 6 months, I'm on to something else. So
yeah, I would, anything you try and do in business will take twice as long and cost twice as much. So.
Yeah. So before we wrap up, is there anything else that you'd like to add when you're talking to young people about your career and thoughts?
Yeah, I think I would just, if you're interested in finance, look at the CFA program, see if that's of interest to you. I would say pursue something you're interested in and not necessarily what's popular. So if you're interested in an area that's not popular, pursue it. And yeah, just give it a shot.
Okay. Before we wrap up, I'd like to take a moment and acknowledge our corporate sponsors. They have a lot of interest in ensuring that the next generation of students and young professionals are considering finance or investing routes. So we definitely appreciate their financial and just ongoing support for our initiatives. And if you'd like to learn a little bit more about the CFA designation, careers in finance, diversity issues, please make sure you stop by the CFA Saskatchewan website or visit the CFA Institute website. Tons of information on careers and opportunities. So please visit. And I'd like to thank again Mark for his time today and his comments. Very interesting and much appreciated. Thank you, Mark.
Thanks, Jordan.